Hi, this is Jerry. Today, let's talk about Bitcoin, so-called electronic gold. Its price dropped dramatically over the past few days. Is this just a correction or something larger? For years, Bitcoin has been the flag bearer of the cryptocurrency universe, the digital asset that drew headlines, institutional money, curious retail investors, and a growing ecosystem of derivative products, ETFs, mining operations, and speculation. Yet, on Monday, November 17 to 18, 2025, Bitcoin once again revealed how fragile the climb can be. It fell below $92,000, wiping out more than 26% of its value from its October peak, and raising the question, is this simply a sharp correction or the onset of a deeper, longer-term sell-off, consistent with its historical 4-year cycle? Data tell the story clearly. Bitcoin hit a fresh record early in October at above $126,000, only to stumble in recent weeks and retrace to the high $80,000. This is not a minor dip. For an asset that had enjoyed headline rallies and investor exuberance, such a move invites a broader examination of risk, valuation, structural change, and investor behavior. Firstly, let's talk about what's driving the drop. There are multiple converging forces behind Bitcoin's recent underperformance: leverage unwinding and liquidations. In a market dominated by leveraged trades, derivatives, and long-only retail bets, a sharp move downward often triggers forced liquidations. Reports show the crypto market wiped out more than $600 billion in value since early October. Not just Bitcoin, but across altcoins and tokens. Analysts note that when positions are large and leverage intense, the unwind takes longer and is deeper. Macro risk, liquidity, and interest rate environment. Bitcoin has increasingly behaved like a risk asset rather than a standalone digital commodity. When central banks, especially the Federal Reserve, signal caution on rate cuts, or when inflation expectations increase, assets like Bitcoin often lose appeal. A spike in general market volatility reinforces this effect. Turning of the crypto cycle and sentiment fatigue. Historically, Bitcoin follows cycles, halving events, followed by major price surges, then corrective phases. Some investors believe that the current phase, which followed the April 2024 halving, is entering a phase where the party begins to fade. Bloggers and analysts are asking whether the 4-year cycle is bringing a deeper drawdown, liquidity and institutional flows stalling. The inflows into Bitcoin-based ETFs, institutional allocations, and new retail demand have slowed. In emerging downturns, the lack of fresh buying deepens the fall. One recent study showed that Bitcoin spot ETF outflows and weak liquidity are already visible. Collectively, these forces have transformed the retreat into something more than a normal correction. Secondly, why the drop matters for Bitcoin's future. This decline is important on several levels, not just for traders, but for the crypto ecosystem, institutional adoption, and the broader narrative about Bitcoin's viability. Bitcoin does not generate earnings, dividends, or traditional cash flows. Its value is driven by supply dynamics, e.g., halving events, demand-side speculation, macro liquidity, institutional sentiment, and network effects. When demand stalls, valuation comes under pressure. The size of the decline, over 26% from peak, suggests either a reassessment of demand or a recalibration of how the market values Bitcoin right now. The supporting data. Bitcoin's 6-month low intraday dips below $90,000 and clearance of AS support. The fear and greed indicators for crypto are flashing extreme fear. Retail boredom, institutional caution, and absence of new entrants amplify risk of a protracted slump. When the narrative shifts from digital gold and institutional adoption to overheated speculation and liquidity vacuum, recovery becomes harder. A major reason many believed Bitcoin's future was secure: institutional entry, regulatory frameworks, ETF approvals, and corporate treasuries adding exposure. But in a decline of this size, questions emerge. Are institutions truly committed? Are they bidding up the price for long-term stays or short-term trades? The recent pullback suggests the former belief may be being tested in real time. What was once pitched as a new asset class decoupled from traditional markets now behaves more like a macro asset linked to liquidity, interest rates, and risk sentiment. That means Bitcoin is vulnerable to the same headwinds that trouble equities, commodities, and risk assets more broadly. Many long-time Bitcoin watchers point to the 4-year halving cycle 2012, 2016, 2020, 2024 and expect a corrective phase post-peak. If this is indeed happening, we may not just be in a shallow pullback but the start of a multi-year drawdown similar to past cycles, albeit perhaps different in shape given institutional maturity. Thirdly, is it just a correction? Or the beginning of something deeper? This is the key question confronting market participants. To answer it, we must examine historical precedent, current structural differences, and potential scenarios. In prior cycles, after reaching peak valuations, Bitcoin entered corrections of 50% or more, followed by extended consolidation phases. For instance, after the 2017 peak near $20,000, Bitcoin collapsed into the $3,000–$4,000 region in 2018. In later cycles, the patterns changed but the theme remained: surges followed by corrections. With current drop of 26% from peak so far, it mirrors the early phase of those deeper corrections. Bitcoin's ecosystem today is markedly different. Large funds hold ETFs, corporate treasuries hold Bitcoin, miners are more regulated, derivatives volumes are huge, global policy attention is high. All of this may dampen the severity of a collapse, but also introduces new risk vectors. The question is, does the system reduce risk or mask it until later? Considering these analyses, there are 3 scenarios for Bitcoin. Scenario A, shallow correction. The decline stops near $85,000 to $90,000, liquidity returns, institutional buyers re-enter, and Bitcoin resumes an upward trend. The current drop is thus a correction within a broader bull market. Scenario B, extended drawdown. The perturbation leads to a deeper correction, $70,000 to $80,000 or more. Bitcoin enters a consolidation phase of 12 to 24 months. Institutional flows slow, retail is discouraged, and macro headwinds dominate. Scenario C, structural reset. Bitcoin becomes more commoditized, interest wanes, speculative narratives shift to other altcoins or technologies. The current drop triggers a re-ranking of crypto fundamentals and risk appetite falls significantly. But which scenario unfolds will depend on following signals: institutional flows, macro environment, on-chain metrics, regulatory shifts, narrative strength. Finally, what should investors do? Given these dynamics, here are key takeaways for investors and observers. 1. Don't treat Bitcoin like a safe haven. The narrative of digital gold endures, but recent history shows Bitcoin behaves like a high beta risk asset. If you treat it like gold, you may be in for a surprise. 2. Size and timing matter. If you're allocating funds, be conscious of where you stand in the cycle. An allocation made near the top can be hazardous. If this is the early phase of a multi-year correction, staying complacent is risky. 3. Focus on flows and structure, not just price. Pay attention to ETF flows, miner behavior, large holder movement, and derivatives metrics. These take precedence over short-term price jumps. 4. Be prepared for volatility and perhaps patience. Even in best-case scenarios, recovering from 20% drop could take months. In a deeper scenario, the recovery might take years. 5. Don't ignore macro risks. Bitcoin's future is increasingly linked with global liquidity, interest rate policy, inflation, and regulatory clarity. If any of these falter, Bitcoin suffers. The bottom line, the drop under $92,000 and a 26% retreat from October highs is more than just market jitters. It is a wake-up call. Whether this becomes a temporary correction or the start of a deeper drawdown depends on variables that go beyond Bitcoin itself. Institutional flows, macro policy, on-chain structure, and sentiment all matter. If history is any guide, and history says it often is, Bitcoin may be entering a consolidation phase, not just a simple pause. But the evolving nature of its ecosystem means the scale and shape of that consolidation could look very different from past cycles. For now, stay attentive, size wisely, don't confuse euphoria for stability, and remember, in the world of digital assets, the risk of the ride is just as real as the promise.